Good morning, everyone. I apologize for the delay, but we are now going to call this meeting to order at 9:11 a.m. Can everybody please rise for the Pledge of Allegiance? And then really quickly, roll call. Chair Brown,
Present.
Vice Chair Olson,
Here.
Committee Member Crutchfield,
Here.
Committee Member Garcia,
Here.
Committee Member Peterson.
Present.
Thank you. For reports for this meeting, unfortunately, there are none. None of the committee members or myself as the benefits manager were available to attend the NAGDA conference. At this time, Luther, Vincent, if anybody was able to attend the NAGDA conference, we would love a short recap if either one of you attended or if both of you attended. Were you able to attend? Did you want to share any snippets from our conference this year? Because we were all unavailable to go.
Yeah, I'll start. You're probably familiar with the NAGDA conference. It stands for the National Association of Government Deferred Compensation Administrators or Defined Contribution Administrators. It is an industry event for the public sector, and so a lot of cities, counties, water districts, special districts, that sort of thing attended. Probably 1,000 attendees. And not only are the sessions really, really informative about the administration of government deferred comp plans, but it's more about the networking opportunities, the people that you meet in the hallways or over meals. And so you can, in addition to learning from the sessions, really speak to some of your peers about how they're doing in city A or county B or that sort of thing. And so I think it's really, really valuable. The next NAGDA conference is in Orlando, Florida, so a little bit more of a haul than San Diego this year, but Orlando is in 2026. In 2027, the NAGDA conference is going to be in San Antonio before it probably, and we'll see, but before it gets back to the West Coast in 2028.
Yeah, just going to echo what Vincent had mentioned. It's really a conference where a lot of other cities, counties, local government get together and kind of lean on each other to see what works, what doesn't within their programs. The sessions are beneficial too as well because it gives you insight on what's working for other cities that do present, that kind of share their ideas of whether it's auto contribution arrangements or getting their participants to increase their contributions or get them engaged with deferred comp. A lot of the sessions are beneficial. We get a lot of feedback from our clients on how effective it is in bringing some of the information from the NAGDA conference back to their cities, incorporating that into their program. And also the events. The events are fun too as well because it gets you to socialize with a lot of other cities, counties, members. Everybody kind of gets together. And it's not only about deferred comp, a lot of the other cities also lean on each other too, connect with their colleagues to see what's going on within their cities and what challenges they're facing too as well.
So I would have liked to attend. I made myself available to attend. Unfortunately, I didn't get the information. I know that we talked about going, and the chair said that if he couldn't attend, that I would be able. I told him that I would attend, and so we just never were able to get our wires together. The information never got back to us about the dates and the availability of who was going to go and who was not going to go. But I was available to attend. I wish I could have been there. I see the benefit of us attending. For the city of Vallejo, I think it's really important that we are present whenever the opportunity presents itself to learn more about deferred comp and what other jurisdictions are doing so that we are just stay really informed. So I think maybe in the future that we follow up. Are you in charge of that? that you follow up with us and make sure, because I did say that I would attend and I would make myself available to go if the chair could not attend.
Sure, I'm sorry, I'm not sure where the disconnect really happened, but we'll make sure it doesn't happen for the next conference.
Thank you so much.
So just to make all things clear, and Jasleen, you did just fine. What we discussed was you would be the primary, I'd be your alternate. I responded to Jasleen later the same day after the meeting, informing her I checked with my wife and couldn't attend.
Okay, so it never got back to me about me attending.
Okay. I'm guessing Jasleen was probably waiting to hear if you were able to confirm your availability.
Oh.
I'm sorry, and when I didn't hear back anything because I thought both of the committee, Chair Brown and yourself were going to come back and let me know if you were available, and then we would proceed, and then I would let Chair Brown know if you were available to go, then he would be back up. But he did let me know he was not able to attend, and because I didn't hear back, I wrongly assumed. But I will double check in the future before we confirm.
Okay, thank you so much. I appreciate that. I think it was just a breakdown in communication. I just want to make sure that it doesn't happen in the future.
But thank you, Luther and Vincent, for the update. For our committee forum?
Through the chair, currently do not have any members of the public signed up for the community forum. If the interested parties are interested in speaking online, please raise your hand. No members have signed up in the chambers, but at the conclusion of the timer that is located on the top left corner of your screens, if anyone signs up, I'll be sure to let you know, but feel free to carry on with the agenda.
Our next item is the approval of minutes from our last agenda meeting. Our recommendation by motion to approve the minutes from the July 28, 2025 regular meeting. Can I have a motion to approve?
Yeah, I'll motion to approve. Chair Brown.
I'll second that. I'll second that.
Thank you. Motion to approve minutes from our July 28, 2025 regular meeting is approved. Oh, sorry. I'll do a quick vote call. Committee Member Peterson,
Yes.
Committee Member Garcia,
Yes.
Committee Member Crutchfield,
Yes.
Chair Brown,
Yes.
and then Vice Chair Olson.
Yes.
And now we can say the motion is approved. And then our first presentation will be by Mission Square with Luther Hermano.
Good morning, everyone. Good morning. So just going to go through some of the slides, agenda items for today. Going to touch on some updates as far as organizational enhancements from the Mission Square end, some of the things that we've been working behind the scenes and incorporating this fourth quarter and going into 2026. So hoping that's going to be exciting for some of the board members. Planned health report, we're going to touch on Q3 numbers, performance, and results, what we did in ensuring we're moving the needle in the right direction. Participant and client engagement campaigns and goal-based programs that we pushed out for the third quarter. And then touching on financial wellness education workshops and CFP programs, some of the additions that we're doing as we push out some of the enhancements going into this fourth quarter and going into 26. Legislative advocacy, just going to touch on some of the Secure 2.0, what to expect going into 2026 as well. Some of the optional provisions that the board may consider in adopting. And then self-directed brokerage account. This is something that I will touch on as far as I received feedback regarding the current investment menu on the self-directed brokerage account through Charles Schwab, going over the current menu when it was first adopted and options that the board can consider if we do want to make any changes to the self-directed brokerage account. We'll go to the next page. That's your team. I'm on the top. The person right below Ryan Bertrand is your boots on the ground. He's your retirement plan specialist, engages with your participants. He is your dedicated rep. Some changes, you notice a new face there. That is a new addition to the team, Regional Director for Northern California. Minu Animalai joined Mission Square. She now oversees Northern California for the participant experience. So Ryan does report to Minu. Minu came over from T. Rowe Price, extensive amount of experience in defined contribution sector and with government. And then Rich Gill is your dedicated certified financial planner. In addition, this is somebody that you don't see often, but this is a part of your team. Jeffrey Hawthorne is your retention specialist. A lot of times when participants are transitioning into retirement or separating from service, they do get contacted by Jeffrey to ensure that they understand their options as they transition into retirement. All right. We'll go to Mission Square updates. So this is something that we take on as an organization in ensuring we're hearing government and getting feedback from government on what they're wanting within their deferred comp programs. Something that we tend to hear often as participants separate from service is options. You provide retirement options, you provide group plans, but we're looking for additional household products for our kids or our spouse or additions to our household. So one of the things that we're broadening is our capabilities. Comprehensive resources into wealth management, we are pushing into this fourth quarter. That platform is going to be available separate from deferred comp for participants that do want to access additional products. So this is something that we've improved, smart technology, quality investments, personal high touch. This is where we're now expanding beyond retirement and providing more of a full spectrum wealth management now for participants. So those that are looking for things like 529 plans for their college savings for their kids, high yield savings, additional products on the outside that they want access to is now going to be fully available for them. In addition to that, other resources and tools we're incorporating. Some of the key areas that we're touching on. On the left-hand side, outstanding service, some of the metrics from an organizational standpoint. Call center survey increases from 3.7 to 3.79. RPS Net Promoter Score at 83. Typically, you see anything above 50 is phenomenal. And then platform updates and enhancements. I touched on in previous committee meetings, enhancements through our call center, pin drop security, where we're ensuring that we're enforcing securities in place to prevent hackers or bad actors from accessing participant accounts. Technology standpoint, I mentioned some of the capabilities not only through our call center, but also through our website. We are refreshing our website to give it more of a modernized feel. In addition to that, we're also incorporating additional resources, tools, calculators to help your participants keep them on the right track for retirement. Things that are coming soon, self-service financial planning for those that don't want to meet with a financial planner, that do want a financial goal plan to create on their own. That's also going to be available coming into this fourth quarter. Websites for both plan sponsor and participants, the refresh as I mentioned, and then also this is something that you don't have to worry about. Within your lineup, you have what's called open architecture, which you have some of the best investments that are overseen by your fiduciary, by your consultant. From the Mission Square standpoint, we made some appropriated changes to our own investments. We'll go to the next screen. So some of the things I touched on, self-service financial planning, broadening our availability for planning services, digital guidance, planning and tools for every stage of life for your participant base, and then also introducing things like budget, debt management, and liability tracking for the calculators and tools that are incorporated into your program. And I touched on that already, the digital experience. You're going to notice as we transition into this fourth quarter, we're already in the fourth quarter, but later into the year, you're going to notice if you do log into your accounts, you're going to notice it's going to look a little different. It's going to have more of an uplift, more of a modernized feel. Not changing the placements or where things are at, but just giving it more of a modernized feel. All right, we'll go into plan review numbers. So third quarter, some of the numbers, as always, I provide perspective of how we're doing, so I'm going to give comparison of third quarter of '24, ensuring we're moving the needle in the right direction. For the third quarter of '25, 35 RPS consultations. RPS stands for your retirement plan specialists. In contrast, '24 numbers, there were 56 RPS consultations, so a slight dip in consultations by your rep. CFP consultations, this was an increase. Eight were provided in the third quarter as opposed to 24 numbers at 1. There was also one on-site service day by your rep in the third quarter. For participant enrollments, there were 21 enrollments provided in the third quarter as opposed to 24 numbers at 38. Also a slight dip there. In-plan contributions, about 936,000 went into the plan as opposed to 24 numbers at 856. Roll-ins, these are participants consolidating assets, other retirement plans into their deferred comp program, to their 457 plan. There were 6 totaling 125,482 as opposed to 24 numbers at 239,000 totaling 7. Cash flow numbers, this area looked significantly great. 1.12 million went into the plan with outflows of about 440,000, netting a positive net cash flow of 676,000. So huge numbers there. Also provide a bar graph to show you over the year over year, what that kind of looks like. Wellness logins, there were 5 total, as opposed to 24, there were 13. Financial wellness center is the area where participants are accessing the tools, calculators, the tutorials, the resources, guides to help them along with their journey. 13 were provided in 24, and then account logins, 2,588 were provided in the third quarter as opposed to 24 numbers at 2,624, so about par there. And then retention, rollouts, there was only one rollout totaling 14,000 as opposed to 24 numbers at 6 rollouts totaling 720,000. That was a 98% decrease. That's huge. Those numbers are that shows you the strength of the plan and also participants engaging and knowing that they're able to keep their assets in the plan and supplement income as they're in retirement, not necessarily having to roll out. Any questions on the numbers, on the plan review numbers? Awesome. Plan balances to end the third quarter, we were sitting about 60 million. 70 million, my apologies, 70 million in the plan as opposed to year over year at the end of Q3 of 24, the plan was sitting at 60 million. That was a 16.7% increase, not only contributions, but also market too as well. And then the next slide just gives you asset allocation, breaking down your plan based on age group demographics, the percentage of participants in the plan on the left-hand side. On the right-hand side gives you a breakdown of the asset classes, the investments that your participants are appropriating within each plan. So darker area, balance or asset allocated portfolios, those are the target dated funds. Lighter area, that's a light purple or fuchsia. Bond fixed positions out of the market, equity market, and then green area, international equity, that lighter blue area, specialty, and then stable value, purple, U.S. equity, more of the fuchsia color. We'll go to the next screen. Contributions and disbursements. The top bar graph shows you contributions year over year, third quarter, from 23 to 24 to 25. 24 to 25 looks about par. In 24, about totaling 1.1 million went into the plan. In Q3 of 25, about 1,061,000, so close to about par there. Roll-ins and contributions kind of total the same. On the bottom, participant disbursements, these are rollouts to other qualified or retirement plans. Huge decrease from 24 numbers to 25. Then also cash flow, significant difference from 24 numbers to 25. We'll go to the next screen. From 24, we still netted a positive net cash flow, about 24,275. Just significant difference in 25 of netting even more, 676,000 in positive net cash flow. So more money going into the plan versus more money going out. That's essentially what you want to see as a healthy program. And then on the next screen just goes over service usage logins, how often your participants are logging or accessing their accounts. You'll notice August, a little bit of a dip, increases in September, and then October, just a slight dip there. On the bottom just gives you service usages counts based on plan. And then on the right-hand side, how many participants are actually registered and have a login versus total participants. So overall, within all of the plans, about 45% of your participant base have login credentials. On the next page, beneficiary designations. This is just strictly the 457 plan. I can provide slides of the other plans too as well, but the voluntary plan, about 67% of your participant base has beneficiaries on file. That's totaling about 376 participants with 187 not having a listed beneficiary on file. Why is that important? I think I touched on this before. You want to ensure participants, as we push out materials or as we get them involved in their deferred comp program, ensuring they have a beneficiary is crucial. If in the case something were to happen or if they were to pass, you want to ensure that their beneficiaries prevent probate. Having a listed beneficiary side skips probate. It ensures the participants or the assets go to the beneficiaries that are listed on file. So, yeah.
How can we do a better job at making sure, because that is really, really crucial. I mean, for people to take money out their checks every week or every 2 weeks and then have it go into this program, and in the event that something happens to them, that they don't have a beneficiary listed, what happens to the money? And then how could a family member who wasn't listed as a beneficiary gain access to those funds? Because, I mean, like 67%, that should be 100%, period.
Yeah, so typically when a participant passes, if they are married, the normal protocol is 50% of it does go to their spouse, the other 50% to their estate. If it's not a listed spouse, or if they don't have a spouse and they're single, then it does go through the probate process. So if there's a beneficiary claiming assets on a retirement plan, they'd have to go through the court to provide a court-appointed document.
So I got a bit of an idea. I brought up a few times, since we have some excess funds in our administrative fund, the idea of doing like a raffle where if people sign up for a webinar, they enter this raffle. I'll bring it up maybe when we get to future agenda items later, but I'd like to bring that back up, that we do that, and perhaps it can come with a check sheet that just says check that you have a beneficiary status. You know, it's not going to catch everyone, but at least get a little more captive.
Right. I think that'd be great.
Okay.
Yeah, we also bring it up, financial planning, Richard Gill, when we do provide the seminars, we do estate planning too as well, in going over ensuring participants have not only beneficiaries in place, but if they have questions regarding other things like, do you have a durable power of attorney? How does a trust work? How does last will and testament work? Appropriating not only their retirement assets, but their whole estate, all assets they do.
So when a person sits down to sign up for deferred comp, is this not mentioned at that time, or is it just kind of slipped into the packet and just like, hey, this is something, you know, I mean, I know that there's a lot of forms and stuff that people are filling out, and it can get lost in the shuffle. So just wondering if there was some way to highlight the importance of that part, that part of the whole deferred comp process, because if I'm consenting to having this money taken out my check, then the next thing on the list should be like, okay, who's your beneficiary going to be? It's, you know what I mean?
Absolutely. Board Member Crutchfield. So one of the things that we tend to see quite often is when participants enroll into the plan, they kind of sideskip the beneficiary area because they don't know what to put down yet.
Okay.
And then they go so this is more of a hands-off kind of account. So they go for years without thinking, did I list a beneficiary? And sometimes when they update their beneficiary through the city, they think, oh, it's going to automatically update through my deferred comp, two separate contracts.
Exactly.
And so, yeah, it's something that we definitely see quite often, and we incorporate communications, flyers that we do try to push out to ensure, hey, along with checking with your accounts, make sure that this is a key area, make sure you have a listed beneficiary designated. So. We
Thank
can
you.
also incorporate things like banners into the website.
I think
so
that would be
participants
great.
Log in, yeah. Appreciate it. Thank you. Email's phenomenal. 91% of participants do have an email listed on file, so they are getting communications from Mission Square. So a lot of the communications that we do push out, whether it's engaging with our goal-based programs like our microsite, email communications, flyers, getting them to engage, they are receiving them. I know sometimes participants do get email fatigue with a lot of things that do come out. So something that that we can partner up with also with the city to double down in ensuring that a message is coming through the city is something we can also do too as well.
It's just 60%, 67% is low.
Yeah.
And especially when we're talking about money.
Yeah, absolutely. All right. Participant engagement, goal-based programs, quarterly for the third quarter, we did push out focus on your future. So again, a lot of the communications that we push out, helping participants engage, making it a fun, interactive engagement for your participant base. On the next screen just shows you some sample content on some of the things that we did push out in the third quarter. And then also going into this month, National Retirement Security Month, we do a dedicated campaign for this month too as well for your participant base, where we push out a dedicated microsite where they can engage. We make it fun. There was a retirement adventure zone engagement to ensure that depending on where they're at in their stage of their career or their life, are they appropriated or are they on the right track? So weekly email campaigns went out, printable flyers, emails, banners. And then you also have access as members to the Plan Sponsor Campaign Toolkit. So if you didn't receive some of those communications, you can actually go to the website. You don't need login access. You can take a look to see some of those communications that were pushed out. You can also download the flyers and communications as well. All right, client engagement, product roadmap. I'll go 2 more slides forward. The top 24 accomplishments, just went over some of the things that we touched on in 24 as an organization. 25, what we're working on this year, and what we're appropriating fourth quarter and into 2026. So some of the things that you're going to start seeing, things like AI solutions, income replacement with our 5 for Life. Some of the things that you may start to see is RHS debit card incorporated into reimbursements for participants. Also an RHS brokerage window too as well that we're incorporating into the RHS plan. Also expansion, as I mentioned, into wealth management products. So additional products and services that are going to be available, managed accounts expansion too as well into advisor managed accounts.
Can I get you to, there's some DCIO.
Yeah, so DCIO Strategic Partner Program is investment opportunities that are partnering with other firms. So partners, things like our CITs or some of the Mission Square investments that we have. Your plan or your investment lineup is open architecture. So you don't have any of the Mission Square investments under your belt, but this would be more investment opportunities for other firms. So if another provider wanted to add Mission Square funds onto their lineup, this would be more of investment opportunities that our organization would partner with them on.
Okay.
Yeah.
And then, and then the OPEB opportunities?
OPEB opportunities. Other post-employment benefits.
Okay, because there's a lot of acronyms, and
Yeah,
so
sure.
what happened is that I didn't see a legend for the acronyms, and that's and so throughout the presentation, I've noticed a lot of acronyms, and I'm one would like to know what the acronyms mean.
Absolutely.
So in the future, maybe we can have a legend, or
Yes, sir.
you know what I mean, for all the acronyms, because there's several acronyms throughout the presentation, and I'm gonna talk about me, sitting here nodding my head, but wondering what these acronyms all mean. And so it'd be helpful to have a description of what these acronyms mean, and so that I can be fully informed, because otherwise I feel like I'm not doing my due diligence.
Absolutely. Thanks, Board Member Crutchfield. So I'll ensure to have that in future. DCIO stands for Defined Contribution Investment Opportunity. absolutely. And then OPEB would be other post-employment benefit opportunities, yeah. So RHS, lifetime income solutions, things like that. Yeah, so I got you. Got you. You're very welcome. The next slide just gives you kind of a breakdown, elevating the RHS experience, so retirement health savings, some of the things that we're going to be incorporating and advocating for. So beneficiary advocacy is something that we are advocating on the Hill. So one of the things, so the RHS plan, which stands for Retirement Health Savings, operates as an HRA, which stands for a health reimbursement arrangement under IRS guidelines. One of the things with HRAs is HRA products, when they were built under IRS guidelines, didn't allow for beneficiary designations. They allow for survivor benefits, so dependents, your spouse, your kids, but they didn't allow for a listed beneficiary. We are headquartered in DC. I was in DC the last week. One of the things that our governmental affairs team advocates on the Hill for is legislative changes. So not only Secure 2.0, but other things as far as retirement products for local government to ensure if there's things that need to be changed. One of the things that we are advocating for is RHS, is seeing if we can get that passed to allow RHS plans to have beneficiaries as opposed to survivor dependents. So that's something that we're advocating for. Debit cards, claim mobile apps, live claims webinars, and claims microsite too as well, strictly built out for reimbursements. Yeah. Plan administration calendar just goes over the year from an admin standpoint as we engage with your HR, things to look out for. So Q4 RMDs are due, finalizing any plan amendments if we're adding any optional provisions, and loan defaults. Financial wellness, just kind of bringing it all together. What we provide to your program, dedicated CFP, plan design, participant engagement with your rep, in addition to the tools and resources that we provide to the program. And then we continue to enhance the Financial Wellness Center to get feedback to see what additions we want to incorporate into some of the calculators, the videos, the tools, and articles that we provide. And then for those that aren't able to attend a seminar in person, we do have, or one of our webinars that we provide weekly. They're also able to engage with the Retirement Education Center, where they already have pre-recorded videos and resource guides available to your participant base.
Speaking of that, was the conference recorded, and were there any ways, were the sessions recorded, and is there any way to go back and look at those from the conference that was just held in San Diego?
I believe they do record the conference, yes.
Not all, but some.
Yeah.
The general sessions,
Yes.
but not the breakout sessions.
Okay.
Yeah. And the general sessions, and Vincent will attest to this, they're pretty beneficial too as well. They're very informative, gives you insight of what's going on in government too as well. So it provides pretty good perspective of where things are out, yeah. Financial planning program. Again, financial planning is available to all your participant base if they do want to engage with a financial planner. Very different. Your rep is really there to provide retirement education, help your participant base understand how the program works, their allocation works, kind of the basics. As your participant base nears retirement, if they're looking more of a comprehensive financial plan, not only focusing on their retirement assets, but their whole estate, looking at a bigger picture, that's where financial planning kicks into the picture. To help your participant base create a plan and ensure that the assets they've built during the course of their career are going to sustain the income that they're going to need in retirement. So some of the financial wellness workshops, we did provide a workshop several months ago with Rich that provided estate planning. A lot of participants, I think we filled the room with registrations. Also the pizza helped too as well. And then also annual webinar schedule gives you a breakdown towards the tail end of the year, November and December, some additional seminars that we're providing, financial wellness seminars that we're providing towards the rest of the year. And then legislative updates. We touched on this, I think, in past committee meetings. I'd have to take a look. I'm unsure if we added this or not. This is something that is talked about a lot as we transition into 26 by a lot of cities, counties. The age 60 to 63 catch-up provision. What this is it just allows those that are within that age group a higher additional catch-up limit than the age 50 catch-up contribution. So right now, participants are able to defer up to $23,500 into their 457 plan. If they're over age 50, you have a $7,500 catch-up provision, which allows you to contribute up to $31,000. For those that are between the ages 60 to 63, it allows them to defer, if adding this provision, allows them to defer up to 150% of whatever the annual age-based catch-up limit is. So for this year, I believe it's $111,250. And then as each year goes by, if the age-based catch-up limit increases, it also increases the limit for those that are between ages 60 to 63. This is optional. It was optional for 24, 25. As we go into 26, it's going to become what's called a negative election, which means that you as a plan sponsor, as a board, if you don't want this associated with your program, would need to sign off opting out, that you would not want this incorporated into your program. I'm happy to break it down. Yeah, one of the things that we get a lot from cities, in some that opt out, not wanting it incorporated into their program, is not having certain elements in place through their payroll to track those participants that are within that age group and the limits that are appropriated for them. So just to give some insight on that.
So can they buy years back through Mission Square? If they have missed an opportunity, can they buy the years back on their own out of pocket without going from their city check and paying that way? Can they buy those years back or that time back?
They can. So there's another catch-up, which is called the pre-retirement catch-up, which is different from the age-based catch-up and the super catch-up. The pre-retirement catch-up allows participants to double up 3 years prior to their normal age of retirement. So if I'm a participant that says, hey, I plan to retire at age 60, and I want to double up on whatever the annual limit is, so say 23,500 times 2, I'm able to utilize any previous years that I was not maxing out in my contributions to double up on whatever the annual contribution is. 3 years leading up to my retirement year.
Can they do that? Out of pocket? What I mean is from their own. So it has to come from their city.
It has to come through payroll deduction.
Payroll. That's what I was asking. Thank you so much.
Yes, sir. All right. And then checklist, any optional provisions that the city, the board wants to incorporate into the program. Standalone form, very easy process. Check mark, this goes through HR. Once the single page form is completed, our plan design team and our operations does all the work for you to ensure that everything's seamless, and we make a DocuSign ready to amend the plan and adopt. And then if we are adopting any provisions, we do support employees in the program in ensuring communications are sent out. So not only flyers, email communications, banners that we can incorporate into the login process too as well.
So excuse me, I know we discussed, I want to say we had made a motion on the age 60 to 63 catch-up in a previous meeting in anticipation of this next year. Does anyone else recall if we had completed that? As we're checking, if not, I feel we should. There's no downside in my opinion. And since you have the form pulled up, just so it doesn't escape my mind, perhaps we can start that process before this meeting's over, and then we can get the form process again. It's by the time our next meeting starts, this will be in effect, correct?
Yeah, absolutely, Chair. So Chair Brown, for participants that are wanting to utilize that for 25, yeah, definitely beneficial to incorporate if we're wanting, if you do hear from your members, those that are wanting to incorporate the higher super catch-up. But for 26, it just becomes via negative election. So meaning the form won't be needed. It'll be automatically added. Yeah,
Well, in that case, then I guess it's moot at
So
this
Chair
point.
Brown, I do believe in our last meeting, in our July meeting, we did vote on it ahead of schedule,
Okay.
just because we had rearranged the agenda a little bit. And the tentative plan was that the committee would take some time to review the information. And then if we were ready for this meeting, then that would be a possibility. But I think just with our committee changing right now, it wasn't possible for us to put it on the agenda for this meeting.
Yeah, no worries. And actually, we're 3 months out of it becoming automatic anyways, right? So we'll probably moot. Thank you.
Yeah, absolutely, Chair. And then the last slide is just Secure 2.0 provisions, so some of the things optional and mandatory, other things like the Roth catch-up wage Roth mandate. I don't believe that applies to the city. I'm unsure if the city pays into FICA, into Social Security. If not, this would not apply to you as an agency. If you do pay into FICA wages, this would apply the Roth mandate. What that is participants that are accruing over $145,000 in income and are utilizing the age-based catch-up contribution. When maxing out on their contributions, that age-based catch-up portion has to be deferred via post-tax, Roth, as opposed to pre-tax. But if you don't pay into FICA, into Social Security tax, the city of Vallejo does not have to adhere to that provision. Yeah. Yep. All right, self-directed brokerage account. So when we adopted this onto the plan, when the city adopted onto the deferred comp program, both 457 and 401A plans allowed for a self-directed brokerage account where your participant base, essentially those that were wanting to open a brokerage account, allowed them other investment options. When it was first adopted, I think this was by default. It appropriated only mutual funds and ETFs. ETF stands for exchange traded funds. Similar to mutual funds, except they trade intraday trading as opposed to mutual funds where mutual funds trade at end of day. One of the things that we do see quite often from cities is, and their members is, if I open a brokerage account, why am I not able to invest into other options than what's available already in my current investment lineup? So your current investment lineup allows for mutual funds, CITs, ETFs, that more put into the objective of long-term investing for your participant base. When investing into a brokerage account, it allows for other security options. And if the board is open to that, open to the discussion of adding that or amending your plan to allow for other security options, you're more than welcome. On the bottom just goes over eligibility and transfer requirements for those that do open a brokerage account. And then on the next page, just gives you Charles Schwab's trading menu change form that allows for other securities that are open to your participant base. So right now, as mentioned, mutual funds and ETFs only. If you did want to open, again, feedback that we've received from others, if you do want to open it up to other trading securities like equities for stock trading, debt securities, exchange traded funds, closed-ended mutual funds, or options, I'd probably say options is not something that we see often. You're able to. You can restrict access for your participant base to certain securities or asset groups, or you can open it unrestricted to all. Completely up to the board. Alternatively, plan sponsors may choose to enable full brokerage access. If you do amend to allow for other security options, it does require amendment of your service agreement too as well. So there would be an addendum included in your service agreement contract, and then also Schwab's trade menu change form needs to be sent into Schwab if you wanted to allow for other securities. And then any questions at all? That was a lot. Yeah. You will get a copy, as always, the board. So if there's any questions that you do have, posts or anything that you can think of afterwards, just let me know. Be happy to clarify anything that was discussed. All right. Thank you.
Thank you, Luther.
Thank you.
And then we have our next presentation by Vincent and Hayes Group. Committee, we did accidentally not receive this particular presentation, so it's not included in your packet for now. But we will be putting it across your screen, and then I'll be circulating it after the meeting, so you do have a digital copy of it.
Thank you.
Great, thank you, Jasleen. Good morning, everybody. Yeah, I apologize for the delay at the beginning of the meeting and the misdelivery of the materials. but it seems like we got everything dialed. Yep, perfect, thank you. And I definitely want to be respectful of the agenda. We have had many clients talk about that very last slide that Luther brought up in terms of the types of securities. Certainly, Mission Square has the ability to administer the types of securities in self-directed brokerage. If the board ever wanted an opinion, not a legal opinion, but a consulting opinion of what we're seeing with our other clients, certainly happy to address that when the time is appropriate. So I wanted to at least add that to Luther's comments on that very contemporary agenda item, or at least the topic. Go ahead and flip into, actually, and sorry, you brought up a very, very good point. In one of my documents, about a year ago, it was asked that we provided an executive summary, and by we meaning Luther / Mission Square and myself. I think it was a great idea about the acronyms. I'm convinced that not necessarily Mission Square, but the investment consulting world uses acronyms to show how smart we are. But it doesn't really help if you don't understand it. And so I think it's a great idea. I actually already have a list of about a dozen acronyms that we can explain. And so if it's okay, we'll just add that to the executive summary so that you know, you can at least follow along our presentations. Speaking of presentation, let's go into the good news on this report, page 1. We do have some relatively good news, at least as represented by the impressive returns in the markets, and markets is plural because we are going to highlight 3 distinct investment categories and the markets that represent those categories. But it's based on maybe a mediocre economy. Certainly there's some relatively good news out of the economy on this page, but there are some weaknesses behind the scenes. And you'll notice on the bottom third, 3 relatively large numbers, and not in quantity, but large in terms of font size. And so if you take a look at the bottom left, the GDP, the second quarter came out at a pretty impressive 3.8%. And that means we as consumers, which drive about 2/3 of the GDP or economic output in the United States, continues to prop up the economy. The other third are corporations and governments, but we as consumers continue to spend pretty well. But when we take a look at the numbers, maybe we're spending money we don't have on things that maybe we don't need. Because when we take a look at that 3.8% impressive GDP print, what we're seeing is credit card balances are ticking up, delinquencies are also ticking up, auto loan delinquencies are also ticking up. We're also seeing, and I may have mentioned this before, a rise in a type of company represented by 2 names, Klarna and Affirm. Do you know what those companies do? Buy now, pay later. So almost at every transaction on the internet, you could choose to buy now and pay now, or what's very, very popular is pay later. And we're seeing those companies doing very, very well. And so that 3.8% number does show some signs of weakening. The other part of it too is we're in the midst of this government shutdown. Typically in this time of the year, we would have the advance number for Q3. We don't have that yet because of the stall in Washington, D.C., or on the Hill, as Luther mentioned. Moving into the inflation rate, this remains stubbornly high. That 2.9% is a measure of the consumer price index. It is a popular gauge of how prices are increasing or decreasing year over year. The Federal Reserve has a 2% target, so that 2.9% is, like I said, stubbornly high, but it is ticking up. It was 2.7 a couple months ago, and so that is causing some concern with the Federal Reserve because one of their missions, they call it a mandate, is price stability. Translated, price stability is a 2% inflation number, and so that 2.9% is about 50% higher than the target. But what's giving them really, really pause is the job numbers. The job numbers, as represented by the unemployment rate, is also ticking up. It was about 4.1%, and it ticked up to 4.2%. The administration fired the commissioner of the Bureau of Labor Statistics because the administration thought that the number was politically motivated, with the job numbers weakening, the unemployment rate ticking up, but 4.2 turned into 4.3. That number is also a little stale because we haven't seen the September job numbers because of the shutdown. My point about the last two numbers is it gives fodder for the Federal Reserve to continue to lower interest rates. If you remember in the September meeting, the FOMC, or the Federal Open Market Committee, lowered rates for the first time in a number of years. There is a 100% chance that they're going to lower rates yet again this week, and then almost 100% chance again in December because of that weakening economy that I was talking about, or at least laying the groundwork over the last few minutes. Generally speaking, markets like lower rates, and so the expectation of 2 more decreases is propping up the markets. If you go into the next page, I'll be brief on the acronyms, but the bottom half of this, you'll see the second line down. The U.S. fixed income is also the bond market or the debt market, as represented by the Bloomberg U.S. aggregate, or we call the AG, bond index. Historically, the dull, maybe even boring bond market averages 3.5% a year. Take a look at that year-to-date number. Already in the first 2 quarters, up 6.1%, which is almost double in a shorter period of time what the bond market typically experiences. Excuse me. You'll notice the bond market has rallied year-to-date as of last week. The AG, or aggregate, is positive 7.3%, so nice continuation of that rally. And then halfway down that chart, you'll see the U.S. large cap equity is represented by the S&P 500 or the Standard & Poor's 500. These are 500 large U.S. companies, typically the household names like Tesla, Nike, Amazon, etc. Year to date, 14.8%. As of last week, 15.8%. So nice continuation of that strong U.S. stock market rally. But the second row from the bottom, the international equity, there are about 45 countries outside the U.S. with an investable stock market. So not only is the S&P 500 setting record highs, I don't know if you saw, but the Japanese stock market called the Nikkei, that also set a record today. That's represented by the ACWI, or ACWI, the All Country World Index. Again, all these are going to go into the legend, which I think was a great idea. You can see impressive 26.02% as of last week, 28.1% on the international side. And that's driven mostly by these trade deals that the administration are striking, propping up international economies, but also given a very significantly weak dollar. Not a good time to be a tourist overseas, but a really good time to be an American investor overseas. So a nice 28% return on that international market as of last week. Questions, comments on that? Okay, let's flip into the reports. Luther does a good job highlighting a lot of the plan overviews, and so I'll be brief. I'll skip pages, not because they're unimportant, but if you take a look at page 11, this is the high-level overview. And you can see across all plans, the 457, the 401, and the retirement health savings plan, you can see just over $70 million. I'm on the pie chart now on the upper right. Broad asset allocation, you can see about 1/5 to that boring bond market or fixed income market, about 1/3 invested in those large cap names like the household names that I talked about, like ExxonMobil, JP Morgan, et cetera. And then that yellow portion is the target date funds, and so just over 25% in those broadly diversified asset allocation models. Anything to call out is on the middle left. We do have 2 search documents, one for the large cap growth asset class and then the international value asset class. We also have an agenda item on the investment policy statement. And then the bottom third is under the fund notes. You can see there are a few funds that are either on watch or candidates for watch. The Mission Square Plus Fund, we've talked about that. I can certainly talk about that as we go into the investment options. Sterling Capital Total Return. Guardian Capital recently announced that they were selling Sterling Capital to Desjardins Capital, and so our recommendation is to place that fund on watch. You'll see MFS Value, Vanguard US Growth, MFS Midcap Growth, and Vanguard International Value. Those funds are currently on watch. And then last but not least, Vanguard International Growth is a watch candidate as well, but that's an agenda item for later in today's meeting.
I have a question.
Yes, sir.
So in the event that an employee comes on, they decide to do deferred comp, and they're not aware of all the funds, where would their funds lie in this pie chart? How would their funds be used?
Well, let me maybe answer it by ironically going to the next section.
Okay.
Flip to page 13.
Okay?
So this would be, if I'm a brand-new enrollee.
Right.
I would see, I'm thinking almost to the exact line by line, the far left column on this page. Now, granted, I would not have access to the beginning balance, the cash flow, gains, losses, or the other columns
Right.
from center to right, but this would be my options as a new participant. Broken down, I believe, by asset class and then ranked generally in risk order. So you would have the 3 fixed income funds, the 3 funds that invest in large company, mid company, small, international, and then the asset allocation. I'm going to turn to see, Luther, does that sound right in terms of what I would see as these broad choices in this order? Or would it look similar or very different?
Sorry. Yep, that's correct. Participants, they do receive when they're enrolling into the plan. By default, a lot of participants default into what's called a target dated fund. But there is annual participant fee disclosures that do go out to participants annually. They get a
Right.
breakdown of all of the investments, and then also they do get communications, as Vincent had mentioned, of all of the funds that are available under the investment lineup when enrolling.
The only reason I ask is because, given all the acronyms, given everything that that we're looking at, it's just like that the normal employee probably wouldn't know exactly where their funds are going. All they know is that they're putting money into deferred comp. And with full transparency, that's what I knew at the beginning. You know what I mean? I didn't know exactly where my funds were going. I just was paying in deferred comp, thinking this is what I need to do to have some money for retirement, not knowing exactly where and how the funds that I were investing in, which accounts they were going into, and what my returns would be on those, on those funds that I was investing through deferred comp.
Absolutely, Board Chair, or Board Member Crutchfield. So even when participants, once they've enrolled and they've gone through, whether it's online they've enrolled or if they did it by form, once they've created login access onto their account, they can also take a look to see what they're invested into, and then it also appropriates the investment options. They can click on the different investments that'll provide them a simple fund fact sheet of the breakdown of the fund, and then also if they want a further breakdown of a prospectus of what the fund actually does, just a more in-depth view.
Right.
They also have access to that as well.
So I think it would be helpful for our employees at some point to think about a workshop on knowing exactly where their investments are going, you know what I mean? So that they would have some idea, because I think a lot of times people aren't aware of all the different accounts. And if we could have a way to inform them of where their monies are going, how their monies are being invested. And so when you just put it in deferred comp, what does that mean? You know what I mean? And how is this dollar going to this fund and this dollar going to that fund? I think that would be beneficial too. So if we could, at some point, during the next workshop or whatever we decide to do, I think that would be really helpful.
Absolutely, yeah.
Totally agree. I think the average participant doesn't know the difference between a large cap company and a small cap company.
Exactly.
And how much should I put in each? Or do I, so I think that is the cruelness of deferred comp investing, is you have the luxury of customizing
Right.
without a lot of knowledge to build your account. Yes, I agree. No, just real quick, and that's why that bottom asset allocation, as Luther said, those target date funds, they're broadly diversified, automatically and gradually get more conservative as that target year approaches. And so that's why these are probably most advantageous for those participants who are either undereducated, I don't want to say uneducated, but undereducated, busy, lazy, whatever. I worked for a company, 401k. They didn't have the top half. They had just the target date funds and self-directed brokerage, and that was it. So it's testament to what your comment was alluding to, yeah.
Just going to add just briefly as we're talking about this, definitely incorporating this into the education workshops with both Rich and Ryan. We try to break it down as simple as possible. For those that take a hands-off investing approach, as Vincent had attested, target dated funds are more of auto-selecting a baseball team for a participant. Whereas if participants want to go hands-on and pick and choose their own baseball players and create their team, we guide them through how that kind of works. So we have a style box that breaks down what funds, different styles of different funds, whether they're value, core blended, or growth, what style is what, and what fits for the participant, and for those that are wanting to build out their team, what that kind of looks like and what their goals are. And the only thing is, as they go more hands-on investing, they also have to ensure that whatever they choose now may not be beneficial for them later as they get older and during the course of their career. So rebalancing and sticking with them. So,
Thank you.
absolutely.
One final thing on this page is you'll notice those target date funds, more conservative retirement income, all the way down to 2065. At the last meeting, the board voted to add the 2070, and that's going to happen in middle December. And so the 2070, this time next year, you'll see a line item, and maybe assets, maybe not, as participants flock to the more aggressive or further out vintage of the Vanguard target date series. On the bottom of page 15, this goes back to a comment earlier that there is a pool of money that the board collects for plan-related expenses. Bottom row, you can see just over $91,000 in the 457 plan. And then on the next page, just putting a pin on that briefly, take a look at the plan growth since 2022, just over $45 million, a growth rate of $20 million, ending the period just under $65 million. So thanks to strong cash flows as well as those impressive market gains that I talked about, the plan has grown fairly significantly over the last few years. This is the 457. The next section is the 401A plan. You can see on page 18, the same menu, obviously different asset size, but this is what the 401A participants can see in their investment menu. And then on the bottom of page 20, last line, and just further supporting your work, there's an excess admin account balance of just over $2,200. And then on page 21, plan growth of this program, ending the period in 2022 at $425,000, now just under $675,000 at the end of the period. And then last but not least is the RHS program, or Retirement Health Savings Plan, on page 23. You can see a similar menu, different capital preservation option with the Mission Square Plus Fund, but the plan growth over time on page 26, also fairly significant, $1.7 million, ending the period just under $4.5 million. So that has experienced fairly substantial growth over a short period of time. Moving into the fund review, and this is where what we do is in the IPS, or investment policy statement, we take a look at the characteristics of all funds on the menus, and we screen those against the metrics in your investment policy statement. On the two right columns, we take a look at qualitative factors. Have assets grown significantly, or have they shrunk significantly? Is the cost structure unreasonable? Has there been significant management change or ownership change? And then we take a look at quantitative factors. We have some expectations of how these funds perform, and if they violate it, it's going to show a red dot on that far right column. And you'll notice the Mission Square Plus Fund, with the departure of Karen Chung Wolf recently, that fund was placed on watch. And even though we have confidence that her replacement, Oliver Meng, is performing well, we're not quite ready to take the fund off of watch. And so that's why the Plus Fund, R10 and S11, given the two different types of plans with the city, it's still showing those red dots. I mentioned Sterling. About 2 years ago, Truist sold Sterling Capital to Guardian, and we placed the fund on watch. We were convinced that nothing was going to change, and it didn't. But now it was announced that Guardian is selling Sterling to Desjardins Capital. And so again, our recommendation is to place that fund on watch given the ownership change. But in our constant contact with Guardian, with Desjardins, and Sterling, we're convinced that nothing is going to change except for the transaction of Guardian selling them. And so again, we have comfort that there's not going to be any disruption, but our recommendation is to place that fund on watch. And you'll notice that due to performance metrics, there are 5 other funds that are violating metrics. And so again, another option further in the agenda is to place two of those funds, one other fund on watch status, but more to come on that. I just want to see if anybody had questions on this page or
I
what
do.
some of these numbers mean.
So I see that the 3 funds were placed on watch under the qualitative factors. Now, what is the difference between the qualitative and the quantitative factors?
So the quantitative is sheer formula driven on performance. The expectation is over a full market cycle, which is 5 years, an actively managed fund is going to not only beat the benchmark, but also perform above the peer group median. And so if there's ever a violation of those, it's going to show red dot. So
Okay.
quantitative is strictly performance driven.
Okay.
Qualitative is more of the art to the quantitative science. Again, if assets grow significantly, there's no definition of significance, but if assets grow or shrink significantly, if the fee structure is out of reasonableness, we'll flag it for qualitative. The two main drivers of that qualitative is ownership change and significant management change.
Okay.
Both of those are impacted by the two funds on the menu.
Okay.
Yeah. And this is where, again, it goes more to the analyst being in regular contact with the teams. On the qualitative side, usually it's a year for the ownership and manager change, and we're not quite there with the Plus Fund. We're close, but there's probably one more quarter. But certainly the clock would start with that Sterling. And then there are other two funds, the Vanguard US Growth and Vanguard International Value. That's in our regular communication with their management team, that something is broken with the process and it's time to terminate and move on. And that's why we have documents later today.
Okay, so how long does it take before we move these off and off of watch status?
On the qualitative, usually it's a year,
Okay.
because the transaction dust will settle and we want to be comfortable with the new structure and that sort of thing. So typically it's 3 to 4 quarters.
And so if it doesn't come off, then if something still is off, what happens?
We would recommend replacement.
Okay.
And at the risk of complicating things further, to over answer your question, the one challenge is the Plus Fund is a proprietary fund. Luther was talking about DCIO, where all the other funds on the menu are open architecture. You have funds that are managed by outside firms away from Mission Square, except for that more conservative Plus Fund. You have a pricing discount on the record keeping fee because of that proprietary Mission Square Plus Fund. It complicates things. If you were to replace it, it may impact your pricing. Now, one could argue that it's not necessarily your fault, so participants shouldn't get dinged
Right.
by the misdeeds of Mission Square. I hate to characterize that, but the personal disruption of the fund manager. But that's one of the levers that Mission Square and all record keepers use to discount or lower record keeping fees if they can get ancillary revenue from some of the funds on the menu.
Okay.
So it's just another nuance with the Mission Square Plus Fund that unlike any other funds on the menu. So those are the actively managed funds. The passively managed index funds are down below. You can see no red dots, which is nice. On the next page, given the chaos over the pandemic in 2020 and subsequent rebalancing in 2022, you'll notice a couple of the vintages have underperformed, but no real issues, because you'll notice that it's only 2 of the 10-ish vintages. And so even though we don't like to see red dots, we're comfortable with the reasons, and Vanguard has fixed the processes so that generally those red dots won't happen again. But still, 2020 and 2022 are in the books, and that describes the 2 red dots on that page. Questions, comments? Okay, let's get briefly into the fee structure, because I do have a couple more items on my agenda. If you flip ahead to page 34, one of the fiduciary responsibilities is the cost structure. Every year, except for 2025, because we're not quite the full year, is represented by a column here. Every column has 3 colors. The light blue is the investment costs. The navy blue is the plan-related administrative allowance account that we'll talk about. And then the orange portion is a revenue requirement maintained by Mission Square. You'll notice that light blue portion has dropped from 20.6 basis points, or 206% to 16.8. So nice work by the committee taking a look at opportunities to lower costs by swapping funds out. And so that fee structure has decreased. The 10 basis point has remained static, and the 2.5 as well. That light blue is a little bit sneaky because it's unlike almost any other expense that we have in our lives, like groceries, utilities, shelter, rent, mortgage, whatever. If you flip ahead to the next page, here we go. Again, every investment option on the menu, but that net expense ratio, second to right-hand column, the fund manager simply deducts his or her fee before reporting the performance net of that fee to you as participants. But it adds up. And so it's somewhat sneaky, even though they're fully disclosed. You can see on a weighted basis on that light blue row at the bottom, 16.8 basis points is about $109,000 a year. That's what participants are paying every year to invest in the 457 plan. Our job is to make sure fees are reasonable, and your job is to make sure that they're transparent. And so that's why we include this every quarter. If you take a look at the next page, that 10 basis points and then Mission Square's 2.5 is $16,000. You'll see the record keeper fee of 2.5 basis points or 0.025%, $16,000 a year, $4,000 a quarter, or $29 per participant. And then the administrative fee is 10 basis points or 0.1%, $65,000 a year. And then I will skip the 401A and the 457 because I want to land on page 43. And this goes back to your point about maybe a campaign or a strategy around the beneficiary designation form. I agree with you that 63 or 67%, the 65% missing designation for beneficiaries was high. That's not my biggest concern. Where we see the stories that are not good are the beneficiary designations that are stale. It's where we have an ex-spouse still listed and we think that we've changed our PERS or our healthcare beneficiary. Again, it's not only the lack of beneficiary designation, but it's the lack of updating them. So you have a pool of assets to use for plan-related expenses. IRS says as long as it benefits the participants, it's a reasonable expense that you can use this money for. So like an old school ledger that, remember that 10 basis points? We collect that and we account for it. So you can see quarter in, quarter out, the beginning balance, any contributions, any growth, any distributions. And at the ending of the quarter, you have $93,420 to spend. And I want to bring it up because it could very well be that beneficiary designation campaign that maybe every participant gets an email or a letter or both that says this is your beneficiary designation. Either it's Sally or NA or whatever, and you participants can say that's right or that's not right. So I just want to table it till this very end page to bring it back full circle to say that's a reasonable expense and it could be a very appropriate way to use these dollars.
I guess if we could go back one slide back, we were talking about yes. Go. You just skipped over. Skip one more, Manny. That one. We were talking about the net expense, and we were talking about how much it costs. One more slide forward, Manny. This one. How much employees pay to be, is that the overall, so as we, overall contribution, there's a cost associated with deferred comp and it goes to Mission Square.
Okay.
So how does that work?
Sure. So let's flip to page 35. Because that's the RHS. I think what you're talking about is a bigger 457.
Yes, this one.
Okay,
yes.
So these are the investment costs that go directly to the fund manager. Now, as I mentioned, the plus fund complicates it because it is a fund, but it's managed by Mission Square. So Mission Square, that first line, the grayed out line, collects 31 basis points or $33,000 a year in investment fees for the plus fund. On top of that, now go to the next page, Mission Square collects the 2.5 of the record keeper fee. but they're different because Mission Square umbrella, there's the investment arm, which is the plus fund, and the record-keeping arm, which is 2.5. Participants don't see, technically, even though it's fully disclosed, I say it's hidden in plain sight. Participants don't see the expense on the investment side. Because you could say it's disclosed somewhere, but participants never see a 31
Exactly.
basis point discount. They will see the 12.5 basis point reduction on their statement. Correct? Yes, okay. So that's where one's kind of hidden and that the performance just is reduced by 31 basis points. So you never really see it as a line item, but the record keeping and the administrative cost is a separate line item that if you're looking as a participant, you can see that 12.5 basis points deducted. Now it's every quarter, yeah.
Yeah, I would gather to say that people don't know what they're looking at when they look at that statement. You know what I mean? They won't know that, and they don't know what it really means. And so I guess part of educating our employees is knowing how to read the statement. You know what I mean? Because these statements come in the mail, and some get theirs electronically. But I would gather to say if I put it in front of someone and say, tell me what this means, they won't know what it means. And I feel like we're doing our employees a disservice by not making sure that they are fully aware of what their deferred comp is and what their investments are. I think that some people may know. I think James knows. I think he knows, but I would gather to say if I put this statement in front of people that they would not be able to tell you what every line item is and what it means. And so maybe there needs to be some work around that as well. And I don't know how to I believe that if we're going to do a workshop, food always gets people there. And we have money for food. So I would say, offering lunch and somehow to make this happen and just a mock statement of this is what your statement means and where to look for and, all those definitions, all those acronyms with definitions so that people can fully understand. Because I think a lot of times people just get this and they go, okay, well, I'm looking at dollars and cents, you know what I mean? And not really fully understanding what the statement means.
You're absolutely right. This was years ago, but there was a recent survey. American workers were asked, do you know the fees in your retirement plan? And the vast majority was not no, even though that was the vast majority answer was, you mean there are fees in my retirement plan? So you're absolutely right, is not only do they not know that they're blindsided that they're paying these fees, and this is why for years these money management firms were making trillions on basis points or half a percentages over billions of dollars. So anyway, it's yes, it is a deep need.
I was just going to attest. I recall, I'm not sure if this was last year or maybe 2 years ago, but I recall the board had brought that up before. One of the board members had brought that up in being able to go through a workshop and walk through the statement with a participant. So your rep, Ryan, he does a great job with ensuring participants understand where to go on their statement, what's what, as far as what's the record-keeping expense versus annual fund operating expenses on some of the investments they're investing into, which are two separate expenses. But yeah, absolutely. I think a workshop with pizza, lunch and learn, and then just going through the basics with the statement and ensuring participants understand that, I think will be beneficial.
Based on how many employees we have participating in deferred comp, I think it would be well worth it to make sure that they fully understand where their money is going and what, I don't think everyone is probably as adept in investing their money and probably just put it in and not knowing exactly where and not knowing which fees and how much they're actually paying and all those things. They're just not aware of what's going on with the deferred comp.
Absolutely. I think for the most part, I think I brought this up before, majority of the time when participants log in, they look at their balance.
Exactly.
And they look at the rate of return.
Exactly.
And if they're making money.
If I'm making money or not.
They're like,
Right.
everything else is irrelevant to them.
Right.
So, but yeah, absolutely. I think it's in full transparency, breaking it down for them
Absolutely.
to ensure that they know how to navigate through the statement.
I'll just add, because some committee members well, I'll put it this way. I've been on since we founded the committee in 2019, right, when we did the choosing of Mission Square, ICMA back then. You're absolutely right. I think part of it also gets resolved in just driving people to go through the webinars on the website, which hopefully maybe a raffle can help with as well. But having said that, just as a casual comment, if anyone comes to you, I know a lot of people in my department come to me knowing that I'm our rep, with general questions of that sort. I can attest, I know Vincent can as well. When we created the committee, when we chose Mission Square, the primary driver was the vast reduction in overall fees that we're paying from our previous grouping of providers. We have multiple. So if there is anyone expressing concern about what they might feel are hidden fees or whatnot, this was a significant improvement over our previous plans. So they certainly are serving as great fiduciaries to us collectively. Everyone has the right and should show concern over anything they're paying for, right?
Right.
But we are definitely getting quite a deal on what we have now compared to 6+ years ago.
And you know, I believe you, and I have no doubt. I just think that a lot of times we are just not aware, and people are just not aware of when they sign up for deferred comp. They just don't know where their money's going. It's just going into an account, and it's like a savings account, like you said. You know, they look and they see, am I making money? Am I losing money? And what's my balance? You know what I mean? And not really aware of any fees or any costs, and probably which companies their money is going and how it's being invested and to what degree. You know what I mean? And I just think that it would be important for people to know exactly where their money's going and what fees and what's all entailed in that statement that goes out every month.
Yeah, agreed. That concludes that agenda item, my report. Other questions?
I just would like to say thank you to both of you for your patience and for all the information that you provided and for hearing us and you know, being willing to go in depth on all the questions, and I just really appreciate it. Thank you so much.
Yes, thank you. I still have a few more items. So you're not getting rid of me. Don't laugh.
Go for it.
I will defer to the agenda chair, staff. Should I just stay seated, keep going?
Sure. Thank you, Vincent, for the presentation. We are now going to go to our action calendar, and I'll give it over to Chair Brown to go through the action items.
Okay. All right, now that we're on, our first action item will be to approve the watch fund continuation of looks like a couple funds here, so I won't list them now because we'll hear them already. Go ahead, Vincent. Yeah, for action item A, we're looking to, per your recommendation, continue watch fund for a few items.
Correct. So,
Vincent, your microphone.
yes. Continuing watch status of the Mission Square Plus Fund, the MFS Value, Vanguard U.S. Growth, MFS Midcap Growth, and Vanguard International Value. Our recommendation is to retain the watch status of those particular funds.
Vincent, I had a quick question. For these watch funds, because we did vote on it in our last meeting, has there been any significant changes or any changes that we should be aware of before we vote on this item?
No. I would say they're getting closer to removing from watch status, but the significant changes would not be worthy of note, no.
Okay, thank you. So, committee, do I have a motion to approve?
Yeah, I'll motion to approve to continue those watch funds.
I'll second that motion.
Thank you. And then we'll do a quick committee vote. Committee Member Peterson,
Yes.
Committee Member Garcia,
Yes.
Committee Member Crutchfield,
Yes.
Chair Brown,
Yes.
and Vice Chair Olson.
Yes.
And motion to continue watch fund is approved.
All right, that brings us to item B, which is the addition of a new watch fund for Sterling Capital Total Return and Vanguard International Growth. Vincent?
So I mentioned the Sterling Capital being sold from Guardian to Desjardins Group. Again, we are comforted by the fact that their pledge that the portfolio team and the process, everything is going to remain intact with Sterling. But given the ownership change, our recommendation is to place that fund on watch. Vanguard International Growth, this fund, basically given its high momentum / ultra aggressive style, underperformed in 21 and 22. It has recovered nicely, but because of those significant underperformance years, our recommendation is to place that fund on watch status as well. So those are the two funds that are new to the watch status, Sterling and Vanguard International Growth.
Just a brief question there. So for the Vanguard International Growth, we're saying, down years, kind of COVID era, it's rebounded, but the algorithm you guys look at over whatever the 5-year or 10-year span is showing that it's still not quite back to where it should be.
Correct.
Okay.
Yes.
And how long would it stay on watch for?
I pause only because I'm using an extreme example as kind of worst case scenario. For quantitative, in my career, I have had a fund on watch for 3 years. It's very atypical, but I would say typically 2 to 6 quarters. So 6 to 18 months would be a general for a good process and portfolio to rebound. There are 2 funds on the menu that are currently on watch, and this is where I pause with the significant. We have 2 funds on watch that we're recommending replacement. So either at the end of 6 quarters, either it's time to move on with the replacement of another fund, or the fund has recovered and is no longer violating metrics.
Okay. Thank you.
With no
Thank you.
other questions on that, I'll motion to approve the addition.
I'll second that.
Thank you. And then a quick committee vote, please. Committee Member Peterson,
Yes.
Committee Member Garcia,
Yes.
Committee Member Crutchfield,
Yes.
Chair Brown,
Yes.
and Vice Chair Olson.
Yes.
Thank you. Motion is approved to add watch fund.
All right, and then this is something new from the time that I've been on the committee. We got a few research documents, review and search documents, I should say.
Correct.
So I need some explanation on that.
Go ahead and, if you can pull up the large cap growth manager search report onto the screen.
Vincent, do you have a page number so it'll be easy for Manny
Yes, of course.
to pull up? Thank you.
Let's go to, I apologize, yep, page 5. So essentially, before we get into page 5 and the details around it, our recommendation as a firm is to replace the current large cap growth manager, which is managed by Vanguard. And we have a recommendation, but our job as a consultant is to present choice to you and discuss some of the pros and cons of possible replacement candidates of the Vanguard U.S. growth. We have 3 similar strategy funds, one managed by JP Morgan, the other by Fidelity, and the third by Putnam. So as I said, these are similar strategy funds. These management teams invest in large growth companies, and so this goes back to an education session where growth could be a term that not everyone knows. Do you want me to spend about 30 seconds explaining what growth is, or do you all are comfortable with what that means? Okay, so there are 2 strategies with investing. There is growth and there's value. Growth is typically managed by portfolio teams that are looking for fast growing sectors or companies or both. Technology is definitely a growth sector. To a certain extent, healthcare, maybe pharmaceutical could also be a growth sector. Energy, more recently, is also considered a growth sector. Communications, another growth sector. What these management teams are doing are looking for momentum names. Essentially, they're willing to overpay for securities as long as that growth, either on the revenue side, top line, or profit, bottom line, or both, are continuing to grow very, very quickly. We call them momentum investors. And again, they're okay overpaying as long as that growth continues. Microsoft is an excellent example. Forever it was a tech company, and then all of a sudden the growth profile started to plateau. They issued a dividend, and it's no longer considered a growth company because it's very mature. Tesla was also considered a growth story, but then all of a sudden the news hit where the price was underperforming, and so that no longer was a growth story. But those are typical examples of growth sectors or growth companies. These managers invest in that aggressive or high momentum names, and that's why they're considered growth. Does that make sense? Okay, great. So then, as we go through this page, we have 100,000 data points, but I want to focus on the most salient ones. And so what we do is we take a look at peer group rankings on the top third of this page. Essentially, Morningstar over different time periods collects all domestic or US large cap growth managers and sorts them by performance. These numbers on the top portion are expressed as percentiles, meaning the numbers will always be from 1 to 100, where 1 is better than 100. Anything below 50th is going to show in red because it's below median. Anything above 50th percentile is going to show in black font. And so you can see the incumbent Vanguard US Growth had a relatively weak quarter at 56th percentile, but the 1-year number is above median at 29th percentile. The 5-year is 78th. The 10-year is just about mediocre at 44th, and then you can see the calendar years. The reason this 5-year number is so bad is because despite the fact that it had a great 2020 and a great 2023, it was almost the bottom of the pile in 2021 and 2022. So you can see the 5-year return is 78th percentile. JP Morgan, on the other hand, has some consistently good longer term numbers, had only a couple bad years, but 69th in 2021, so similar to the Vanguard, didn't perform well, but it was better than the 85th. And then in 2023, it was 65th percentile. But other than that, relatively healthy performance, and that's why you see a 5-year number in the upper quartile at 20th and the 10-year at 5th percentile. Fidelity Blue Chip Growth, another good long-term performer, has only 1 calendar year of underperformance. It was 86th, as you can see in 2022, but upper decile over the 3, 5, and 10-year. And then you can see Putnam Growth had a good 5-year performance at 25th and a stellar 10-year return at 9th. No calendar years of below median, but you can see year to date is showing in that red font at 62nd. How does what? Sorry.
Like, how does it happen that we can see how they performed all these years and they've been pretty consistently? How do we end up at 62% or 62 for a year to date?
Why did it underperform so well? Underperformed so much, not so
Right.
well. For Putnam, I'm unsure. Probably did not own some of those growth stories like NVIDIA or Apple. Probably just thought that they were a little too frothy and underweighted them,
Okay.
and those names continued to rally.
Okay.
But you'll notice for the quarter, it was 33rd percentile. And so maybe they got religion and came back to the Magnificent Seven or the AI story.
Yeah.
Yeah.
Okay. It just seemed like they were doing all right. You know what I mean?
Yeah.
And then to have to be that 63%, was it 63?
Not so much, yeah, 62, 63,
62?
yeah.
Yeah.
The middle portion are the absolute returns net of fees, but there's so many data points. What I like to focus on is more on the bottom third. Basically, it's any outperformance of the benchmark, which is the Russell 1000. If the fund outperformed the benchmark, it's going to show in black font. If it underperformed the benchmark, it's going to show in red font. And so that's why, for those two reasons, I like the bottom third as opposed to the middle third. And you can see not a lot of funds have outperformed the benchmark. And it goes back to the whole tech-driven, high-momentum AI story with the Magnificent Seven and a lot of the chip makers supporting those data centers. And so you can see the Vanguard over the short term as well as the long term has never beat the Russell 1000. JP Morgan has beat it only over the 10-year cycle. Fidelity, there's a smattering of outperformance over the benchmark, but Putnam, similar story, has never beat the Russell 1000 over the short term as well as the long term. Now it's a different story as we go out into the calendar years, but you can see return relative to the benchmark on the bottom portion. If you take a look at the next page, I want to focus on some key data points. Focusing on the top half, what we do is over a full market cycle track not only the performance, which is the annualized return on the vertical or left-hand axis, but we also take a look at the amount of volatility or risk or wiggle as defined by standard deviation on the horizontal axis. Our job, or the ideal, is to get in the upper left-hand quadrant or close to that as possible, essentially maximizing return without taking on any risk. Since that's impossible, especially in a large cap growth portfolio where there's a lot of volatility, getting as close to that as possible. And you can see there is somewhat of a grouping. There are two circles. One is the index and one is the average peer group. But you'll see a blue square, which is JP Morgan, and an orange square, which is Putnam. Way out to the right, we're essentially not necessarily getting paid for it, but taking on a lot more risk, is the Fidelity and the incumbent, which is represented by that red triangle, the Vanguard US Growth. So this is now the first part of, okay, maybe the incumbent isn't the most appropriate. Maybe one of the blue squares or the orange squares is more appropriate, at least from this chart. Moving down into the bottom left, we take a look at Sharpe ratio. The Sharpe ratio is essentially the risk-free return divided by the standard deviation. Another way is the higher the Sharpe ratio, the better. And so you can see the Russell 1000 growth, which is the second to left, that's the index, is 0.79, followed by the blue rectangle, which is 0.74, followed closely by the green, which is 0.7, followed closely by 0.68, which is the orange Putnam, and then the incumbent is on the far left, which is the least amount at 0.47. So this chart shows JP Morgan shows better than the incumbent. And then downside capture as well as upside capture, we want to see not only have the funds participated in strong markets, but do they have some downside protection, or are they participating in weak markets as well? You can see the red incumbent participates only 98% of the time in strong markets, but it captures a whopping 119% on the downside. And that stands logically because, again, on the chart on the upper part, there's a lot of risk to that portfolio. A little bit more constrained is the JP Morgan. It captures only 92% of the upside, but only 94% of the downside. And then moving from blue to green, you can see a nice 108% capture by Fidelity on the upside, but it captures also 112 on the downside. And again, it's just a little bit riskier profile. And then the Putnam, only 98% on the upside and 105% on the downside. And then obviously the index is 100% because it is the benchmark, and that's what we're comparing it to. And then on page 7, just tracking to make sure that these are investing in large companies exhibited by growth. There is a big grouping, and so really nothing worthy to call out there. But I do want to focus on page 8, the cost structure. And this is where it gets a little bit complicated, because taking a look at the top portion, the middle column, the EXP, or the percentage of expense, Vanguard US Growth charges only 22 basis points, or 0.22. The next least expensive is JP Morgan at double that. But that is the least expensive of the replacement candidates. Fidelity charges 54, Putnam at 58. But keep in mind, all of the previous performance numbers are taking fees into account. In other words, the performance numbers are net of fees. So this is where typically a discussion happens, and I want to be respectful of time. I did lose track. How are we doing on time?
We're okay for now. We have about 10 minutes.
Okay, okay. So again, our recommendation is to terminate Vanguard US Growth. We feel that there are other better replacement candidates, and that week, 2-year period, it's going to take a long time for that fund to recover. And so in talking to these teams, our analysts feel that it's time to move on. Thoughts, questions?
So for clarification, essentially, we're putting into consideration the replacement of U.S., I'm not sure I say it right, but the Admiral Fund with one of the other 3 or 4 was. So from my recollection, I think we were considering taking the Admiral Fund off the watch at one point. I guess we didn't, and I'm fine that we didn't, especially considering what we're seeing here. But it seems like they've been pretty close to removal in the last year or so. And then based on like expense ratio, which is something I probably look at more than even some of the other items personally, to me, they seem to be still the best option. That's my opinion and thought, but of course, whatever anyone else wants to bring up for consideration on that potential change.
So did you want to do the vote for all
I'm
3
completely
together?
fine with the vote. I just wanted to make sure everyone had the chance to bring anything up. So if I were to make a motion, but I want to give everyone the chance to speak, my motion would be that we just keep the U.S. Growth Admiral Fund in place and don't replace it based off of the metrics we just saw. But, all right.
Any questions from the committee?
So Kevin wants to just keep it on watch list for now, with consideration to replace later?
So this would be to replace the fund entirely as an option to invest in, correct?
That is the recommendation, is to terminate Vanguard and replace it with one of the 3. It sounds like you're saying, let's just keep it for now and then address it later on.
Right. So for clarification, James, so yeah, not just a watch fund replacement, an actual.
No, like I said, so we're not going to replace it all. We're going to keep it on the watch list, excuse me, for now. Check metrics at our next meeting.
So this would keep it
This would
as an
keep it-
investment option, but also on the watch list.
Yes.
The consideration would be potentially to take it out entirely from our choices
pick another
of
one.
funds,
Yeah.
correct?
But can you pull that slide back up? So what I'm hearing is get rid of the Vanguard, or remove the Vanguard, not get rid of, but remove the Vanguard and replace it with one of these other ones that are doing better. And based on what we've seen, Fidelity Blue Chip or the JP Morgan are doing better. So why would we not do that?
So I would agree with you. I would also agree with Chair that maybe keeping it in the plan makes the most sense because of the recovery. That's not the recommendation, so I don't know why.
Well, that's what I'm
I don't know
going
why. I guess, and now I'm getting into Chair Brown's head. Why you would is if you go back to 5 and take a look at the recent peer group rankings of the incumbent, is they've recovered nicely, is what I'm the rationalizing of keeping in the plan. But the recommendation goes back to terminate Vanguard and replace it with one of the 3. The 3 are all appropriate candidates. We do have a ranking of the 3, but that would be our recommendation.
I'm okay. I'm new to the committee, and I haven't been following it, and so I would definitely acquiesce to whatever for the good of those who have been on the board or on the committee the longest and who have much more knowledge than I have. But at the same time, I do see the other ones doing really well, but not having had the benefit of the long term to watch these grow over time. So I would go with whatever was the
I have a quick question, Vincent. How many quarters has this been on the watch fund?
The second quarter of 2022.
That's a long time.
Very long time.
That's a long time.
Would it be appropriate, committee, if we asked highest group to prepare a correspondence, either some kind of graph showing us from the moment this has gone onto watch fund till now, the changes that we've seen over the quarters, so we are able to assess
He just did that. Didn't we see
for
that
all
in
quarters?
What, didn't we see that overall in one of the slides? I'm sorry,
Yeah.
I thought,
Yeah, I think, yes, everything in our book that I just presented is as of September 30th. What you're talking about is from that time, every quarter, the performance.
Yes, specifically just for this watch, for this fund. I think it will just make it easier for the committee to be able to focus on one narrowed kind of focus area rather than the whole booklet and your whole presentation, and kind of it gets a little skewered at times. So I think according to Chair Brown, it will help, especially because we have so many newer committee members, for them to see the progression just for this. And then maybe at the next committee meeting, we can make a definite decision by then because they'll be more informed about it.
right, but I think that, I thank you for that recommendation, but I think that I would want to see how the ones that in comparison, to see how the other ones have been doing as well. You know what I mean? If we're going to go to that level of detail, then I want to see how the other ones have been performing. Maybe it will put it in better perspective for us.
So not to jump ahead, but we're going to be going through something very similar on action item D, right? Just for now the international value asset class, right? I read into these things quite a bit, but it doesn't mean I can spin my propeller here and give an answer that I think would satisfy, I don't want to say satisfy, but what I can speak for, that's the reason why we have a committee, right? For me, again, maybe I overvalue in my own head expense ratios. Is there a way in which a hypothetical $100 over an exact period of time with expense ratio factored in compared to also their performance, and then that way you could see, this one's been on watch since mid-2022, $100 would now be this, but for the other funds it'd be this, again with that, not just the performance, but also the expense ratios factored. I don't know if that's too complicated or creative of something to ask that were to get produced.
Sure.
That'd be one. Two, another thought that came to me while you were speaking there, Derek, is going back to the education of our members of this stuff. For me, I used to have a lot of U.S. Growth Admiral. I got rid of it back in 2022 when it went on the watch list, right? So I could sit here and, on a personal level, not care if it gets replaced or not. I don't have anything sitting in that fund. But that's not to say that our members don't, because they don't see the red dot that we see when we meet once a quarter on what is watch list and what's not. Again, not to get on into the weeds and into a tangent, but as we start to brainstorm ways to get people more educated and involved, but I don't know if that's a flag that, I've never seen it from the personal standpoint when I log into Mission Square. If it, I'm sure it's findable, so I'm not saying it's not viewable that something's on watch list, but if things were flagged, are they flagged in such a way that is obvious, and have I just overlooked that when they go into watch status?
Not necessarily.
Okay.
Sorry. To answer your question, Chair Brown, not necessarily. So under Vincent's, of course, recommendation, it'll stay on the watch list until an appropriated change is made. We are neutral, per se, with the investments. We're able to go over the investments with the participants, but in turn, they're still there to make an informed decision. So your reps like Ryan or Rich, they can go over the investment returns, whether it's a 1, 3, 5 year of the investments. If they're doing a full review for the participants, they can go over whether it's been underperforming or overperforming. They can go over what funds have been performing well in the market year over year, but in turn, the participants still have to make that informed decision. So we can't advise them and say, hey, this fund's on watch, this fund's not performing as well as these funds, then it would kind of steer into the advising standpoint. So if a fund is replaced by the committee, or the committee does vote to replace, we do provide communications on why it was replaced and for what reasons, but we don't prematurely send out anything with regards to whether or not a fund's on watch.
Okay. On that note, if we made a switch and we have participants currently in this growth admiral fund, do they automatically roll into the replacement fund? Do they need to take action to? Okay.
Yeah, so if the committee does decide to vote to replace, whether it's the international or the growth fund, participant communications do get sent out to participants, typically 45 days prior to a fund change happening. All of the assets that are within the fund that's being replaced will transfer or be mapped into the new fund. As plan sponsor, it will go to HR for review as far as the plan sponsor notification, participant notifications that are going to go out. That can also be provided to the board too as well if you'd like to be copied on that. But yeah, we do provide communications, both email, by form, and also web banners too as well.
Yeah, and it would be interesting for me to know how many people are impacted if we are making these changes on behalf of everyone else. You know, how many people are going to be impacted? And that was how I felt. No one gave me. It was just like, oh, guess what? We're going to Mission Square, but I was with someone else. And then so it's like the decision was made and I didn't have any knowledge of the decision being made. It's just like, this was a city decision and this was it, that was all. And so I would like to know how many people are going to be impacted by the decision if we decide to move,
Yeah.
you know?
It's in the part of the presentation that we don't immediately have access to, but I think Manny might. There's a slide that shows for the 457, the number of participants in this fund. So we could estimate based off that. It doesn't mean we know the exact dollar, or maybe it does show dollar value as well.
It does show dollar value too as well.
184 participants.
That's significant.
That's significant.
It is.
That's a lot.
Yeah, $8.5 million,
That's a lot.
13% of the portfolio, yeah.
That's a lot.
Yeah, so I hear what you're saying, maybe sit on it. I mean, I'm leaning that way. Again, my initial thought was just keep it because I know they were saying to keep it as the choice as opposed to the other three, because I remember us having a discussion once, it was a year ago, of it possibly coming off watch fund. Again, Manny, are you able to pull up the slide that shows performance? It might have been, it was somewhere between, it was either page
Probably
five.
five.
Yeah.
Page 5.
I mean, in theory, right, the watch fund has been us watching it, so those tabling it just, it's a no action. So, again, my propeller going, what I look at is those really bad so top line,
Yeah.
bad 22 and 21 years. And then again, yes, third quarter of this year, but outside of that, year to date, 1 year, 3 year, all are above the 50th percentile. So I don't know what the hiccup was with what's inside of that fund that in the third quarter caused it to stumble, but that's also not a significant drop below the median there of 50th percentile. That's the way I look at it. I see good years post 2022, especially 2023, even 2024 is pretty good. I think that shows that it's tracking the right way, and then it just had one stumble so far this quarter, but you can still look year to date is 36th percentile. For the year, it's 29th percentile. So those are pretty positive numbers compared to the benchmark is the way I look at these things. And then you factor in, again, maybe it's just me getting too deep into expense ratios, but everything else costs more to be in. So unless we're confident they're going to outperform, if they just equal what the U.S. growth admiral is, then in theory we're losing potential gains off the investment.
Okay. I'm good with it. I'm good with it. I just.
No, it's good discussion. It's the first time we've gone this in depth on anything watch listed or otherwise, which is good because now we know really how to make the comparison. So unless anyone wants to throw an amendment, my way, I'd say my motion is to retain Vanguard U.S. Growth Admiral, both as an investment option and also to, of course, retain it on the watch fund list.
I'll second.
Okay, then we'll do a quick committee vote. Committee Member Peterson,
Yes.
Committee Member Garcia,
Yes.
Committee Member Crutchfield,
Yes.
Chair Brown,
Yes.
and Vice Chair Olson.
Yes.
Motion is approved.
So it brings us to item D, which will be a similar discussion. Let's see if you've got something more.
Keep going.
And actually, we are at 11:06. I know we still got to get through them, but do we need to really hyper expedite?
We may, yes, because we are over time.
Okay.
And I know that the committee, trying to be respectful for everybody's time. So if it requires additional items, if you would like to move it to the next agenda item, we can. And if you want to have the discussion first and then think about it a little bit before we vote on it, we can also do that as well.
Okay. It's not huge, but I know I'm missing a secondary meeting to be here.
Yeah, can we just power through it real quick?
Okay, let's push through.
Real quick.
I'm sorry, what was
Well,
the
not real
decision?
quick.
We'll move forward with item.
Okay,
D if you wanna do
I
the
will be
presentation.
brief. So back to my growth story, there is a complementing other side. It's called value investing. Whereas I said the growth managers are willing to overpay, value is the exact opposite. They're looking for diamonds in the rough or stocks beaten down with the turnaround story. They're looking for stocks on sale. Traditional, kind of the dull sectors, financials, utilities, consumer staples, things that aren't really, really sexy, but the value managers are focusing on those sorts of the segments of the economy. So taking a look at the next document, the international value. The other component is it is investing in value companies or value sectors on the international side. So page 5 of the international value search, you'll have the incumbent Vanguard, coincidentally, is the Vanguard International Value, with 3 possible replacement candidates, one managed by DFA or Dimensional Fund Advisors, Dodge & Cox, and Hartford. And you'll notice this might be a different, but maybe an easier discussion around the performance of Vanguard International. You can see Vanguard International in the peer group rankings has struggled close to bottom over the year to date, as well as the 5-year and everywhere in between. Just under median at 10-year, and then the third quarter has rebounded quite nicely at 27th percentile. It has moved back a little bit less growthy, more to the value side. But the other thing too is you'll notice that the calendar year returns. I did pull 2018, which is not on the screen. 2018, the peer group ranking was 34th. In 2017, it was 8th. And in 2016, it was 30th. So short of the peer group rankings on the calendar years, up until 2021, it had 5 years of solid outperformance. It just whiffed it in 2021 into and throughout 2024, except for, as you can see, the third quarter of 2025. DFA is showing a little bit better. You can see the 3-year number was right around median. The 12-year number is a lot better at 12th, and the 10-year number is 12th. Dodge & Cox also had a relatively weak 3-year number below median at 64th, but upper quartile at 21st over the 5-year, and then 26th over the 10-year. And then Hartford is 14th over 3 years, second over 5 years, so it doesn't get much better than the 5-year number for Hartford, and then similar at 4th percentile over the 10-year. And then true to form, bouncing down to the bottom portion, you can see on the bottom third, Vanguard International has not beat the benchmark over the short term nor the long term or anywhere in between. DFA has beat the benchmark over every time period. Dodge & Cox struggled in this quarter as well as over the 3-year, but not by much. Over the 3-year, lagged it by 16 basis points. And then Hartford has beat the benchmark fairly handily over the longer term, except for the quarter. And then if you flip ahead to the next page, a similar looking chart. Again, we want to get to the efficient frontier or as close to that upper left quadrant as possible. You can see somewhat of a grouping, back to my point about the two circles. One is the index, one is the average peer group. And then you can see the blue square and the orange square, which are fitting pretty nicely. And then the red triangle and the green square, which is the Vanguard International Value and Dodge and Cox, struggling a little bit compared to Hartford and DFA. I already talked about the Sharpe ratio, which higher is better. And then the upside downside capture, you can see which funds have participated nicely in the strong bull markets, but which funds have participated not so nicely in the weaker bear markets. And then on the next page, back to my point about the style, and you'll notice the two words on the bottom, value and growth, but you'll notice that the green square is a little bit more growthy than the peers, not by much, but that's Dodge and Cox. And then you can see the incumbent Vanguard International, which is that red triangle. So just a little bit more growthy, but there is somewhat of a tight group, not as tight as that previous search document. But you can see the blue and the orange squares, which is DFA and Hartford, a little bit more value bent than the other two. And then back to my point about the expenses. On page 8, you can see a significant difference in the cost structure. Vanguard International Value, I'm on the middle column on the top half, charges 36 basis points or 0.36%. DFA is a little bit higher at 38. Dodge and Cox, 52, and Hartford at 81. I do want to remind you that all those performance numbers or previous sections factor in the expense, and so all those numbers are net of that fee. But that's the cost structure of the international value managers. So the waning minutes, any questions, comments?
So my opinion, different than the previous search document we just went through. This one pretty clearly underperforms compared to its competitors. From the early slides, I was highly convinced that either the DFA or the Hartford might have been the better choices. They were far outperforming. And then we got to the last slide with expense ratio. And can you just pull that last slide back up, Manny? Wait for it here. I believe Hartford was the one that had that 0.81 expense ratio, so significantly higher than the Vanguard, but the DFA was negligible higher. So again, I'd like to hear anyone's thoughts and opinions, but I'm of the belief that perhaps making the switch, getting rid of the Vanguard option and replacing it with the DFA, which was showing outperformance, but also essentially a virtual tie on expense ratio would be what my opinion is.
I think I would have to agree. And so just in seeing what I've seen in the slides, that I would have to agree.
Does anyone want to push for a different fund or push for retaining the Vanguard fund?
No, I don't.
So my motion would be that we replace and I don't have the exact titles in front of me, but the Vanguard value fund that we just discussed with the DFA value fund that we just received the presentation on. And out of curiosity, since it's new to us, would it immediately enter a watch list just so we have more attention to it, or what would happen if we were to make the switch to any replacement fund, as far as watch fund status or not?
Sure. The Vanguard fund would remain on watch until it's replaced, which I'm looking over at Mission Square at Luther. Probably going to be happening in mid-January.
If it were replaced with DFA, would that have any automatic placement on the watch fund just because it's new to us, or because of its performance, it would be
I
considered?
understand what you're saying. It's
Yeah.
like if we're making the switch,
Yeah.
do we want to put it on the watch on a watch list so that we can watch it perform, as opposed to would we have that ability?
Yes, but item 8A continue the watch status of Vanguard International Value. So if you're thinking of placing International Value on watch, it's already on watch.
Right, so back with Derek, my question was just either A, would it be automatic, which it sounds like it's not, or B, could we elect to place the replacement fund, which it sounds like we're leaning towards DFA, into watch status purely for the purpose of keeping a closer eye on it just for whatever period of time, since it would be a new fund to us and we made, I don't want to call it drastic, but a decision to alter anyone's elections who might have that Vanguard value fund already in their portfolio.
Gotcha. So how, and again, I'll be the interest of time, I'll try and be brief. The watch process or the watch status is simply a function of trust law in California. It represents best practice because I think the pushback, and I've heard it in my 20 years, is don't you watch all funds, or like what's watch status? And I have some IPSs or investment policy statements with no watch. Either a fund is appropriate or it's not. But that's not the case here. And so I want to maybe answer your question again briefly. So essentially, if there ever is a challenge by a participant, by a lawyer, by the IRS, and you said, you committee, this fund was underperforming, you could say, yes, we put it on watch status, and there was a formal process, because the legal standard in California as fiduciaries is not the outcome, it's the process. So having this watch supports this process of monitoring, selecting, firing the funds. To get to your question, Chair, is would we put the watch on the DFA or through this process? The Vanguard International, yes. DFA, no, because it's performing well, and we're watching all of the funds. The watch status is just a label for the underperforming funds or the violation, so that we could say to participants or the bar or the IRS that, yes, we're aware of the underperformance and we were dealing with it in a regulated, prudent process.
Understood. So it doesn't meet the qualitative or quantitative requirements in order to be placed on a watch fund for its own accord. It's less of a decision just amongst us. It's more of the actual qualifiers and quantitative
Correct.
metrics. Okay.
But the reason I will explain it real quick is because we will watch it and we'll be in constant contact with DFA, Dodge and Cox, all the other ones, because that's our job, is to make sure that the funds are still the most appropriate for Vallejo participants. Yeah.
Understood.
Yeah, sorry.
I'm ready to motion unless we have other thoughts. So my motion would be that we remove the Vanguard International Value asset class that we have had, and we replace it with that DFA International Value class.
I'll second.
Thank you. So we'll do a committee vote. Committee Member Peterson,
Yes.
Committee Member Garcia,
Yes.
Committee Member Crutchfield,
Yes.
Chair Brown,
Yes.
and Vice Chair Olson.
Yep.
Motion is approved.
So that brings us to the final action item E, another review of a search document, but this time for a draft investment policy statement.
This is where I'll defer to you. The changes are very, very minor. So either we can certainly table it in the interest of time, or we can deal with it because they're so minor. So I will defer to the board and staff.
I'd be fine with tabling this one.
Okay.
You guys okay with just being in time? Okay.
So Chair Brown, are we tabling this matter for the next committee meeting?
Yes.
Yes.
And that concludes the action items, brings us to agenda item 9, which is future agenda items. Item A being annual investment policy statement for quarter 3, sorry. Is that a presentation we receive, or is that just for our discussion?
I have not received the documents for this just yet. I
Okay.
do believe it's going to be hopefully incoming, and I think, as Vincent had said, I think we don't have the,
see.
was this the one that we don't have the policy statements just yet?
No, Michelle emailed that to us. It's the Word document that I emailed to you, Mandy, so.
Okay, then I will,
Sorry.
it's okay, then I will circulate that to the committee. Like I said, we didn't get all the attachments, so I will send that after
Okay.
this meeting.
Perfect, we'll review it in preparation for the next meeting. And then for well, future meeting dates, which I did see that in I believe the agenda. We're not making changes to the concept of it being, what is it, third week on a Monday,
It is the last Monday.
last Monday?
Yes, so our next meeting will be January 26, 2026.
Okay. And then, and I'll make this fast, there are two things I want to add. I said I brought up at least one of them before, but I want to make sure we do include it. So we have quite a bit growing in that administrative fund. I'd like to, I believe the right way to do it is I need to bring it up and then we vote on it in the next meeting. But it would be for a incentivized raffle in which I'm open to anyone's recommendation, but $50 gift cards, I'm thinking 5 of them. That's $250 per quarter. And I remember Luther saying a while back, you can see who has logged in and viewed a webinar. So we can essentially pull that list once a quarter and come up with a randomized way in which names get pulled out. Congratulations, you get the $50 gift card. So I don't know if Mission Square should send the email to our participants or if HR should, but of a notification of, hey, if you start to log in each quarter and view at least one webinar, you would be entered into a raffle. And then you'd provide the names in which someone probably not directly on the committee, but could pull the names from the hat, for lack of a better term, in order to award those raffle prizes.
So Chair Brown, usually that does go out of the benefits department. And then once we vote on this, then we can kind of connect this with the Lunch and Learn and kind of send it out through our email chains and coordinate that effort.
Okay, that sounds great. Do we need to do anything to make sure it happens? I just, vote to put it in progress, or can we, I mean, if we're spending money, we need to have the vote, right?
Yes.
And
So I'll add it to our next agenda, and then we can vote on it in the January, and then it will be enacted after that if it's
starting after
approved.
that?
Yes.
Okay, everyone okay with that concept? Okay, and then the last thing is a little bit new, but Luther and I had a little bit of an email back and forth over the last 2 weeks. I've had some members request that we open up investment election options into more of Charles Schwab's list of options. I know I have the printout here. So for the moment, my request would just be for future agenda item for the January meeting that we add a presentation about Charles Schwab's options. And I'll just leave, I printed 3 of them, but I'll just leave them. Anyone can grab them. I can forward the email to you that includes this attachment, so that way it can go out to the whole committee. There's a form that calls for us to choose if all Charles Schwab options get opened up or just select ones based on their asset class and different categorization.
How are they performing?
So that would be part of the presentation, right? So, but they're much like what we already have options to, and persons can choose based on they're being more aggressive, less aggressive, et cetera. Yes, Luther?
We can't hear you.
Sorry, I was just mentioning, Chair Brown, Vincent also had mentioned too as well on the SDBA for the securities option. I could partner with Vincent. He can also weigh into fiduciary-wise, not only his fiduciary oversight, but your fiduciary oversight as committee members too as well will be appropriate, and kind of go through that too as well as far as security options for your members.
Okay.
Yeah.
And then with that coming in the January meeting, very quickly, would it create an additional administrative cost if we were to add Charles Schwab options?
Nope.
No?
No additional cost. It's just more exposure to securities.
Okay.
Brokerage accounts are more short-term investing, right?
Right.
As opposed to the mutual funds and ETFs where they're managed by portfolio managers. So additional risk involved, and we can go through that too in the next session.
So, and I'll make this like my closing statement essentially. So I've had more than one of my members bring this up, request access to it because they have Charles Schwab for other reasons. This would just open up investment options, but as Luther stated, there does come additional risk with any time you have additional options, and especially with some of the types in the Charles Schwab portfolio. The idea, I'm not trying to push for something that creates more risk on our members collectively. The way that these members have brought it to me is each person gets to choose what to do with their own money, and this is just additional options. So I'll make the recommendation in the January meeting, but I essentially would like for us to open up to those options. And then I think we have to incorporate moving forward, if we were to vote to choose to do that, additional just education, right? If, hey, we say, you get to invest in these new things that have higher risk, here's what that means. But I'm not saying we're putting any of it all on black, right?
So Chair Brown, if I'm understanding correctly, we will do a additional presentation in our January meeting about the child swab and getting information on that, and then we will be adding the voting for an action item in the following meeting, because we won't be able to do the presentation and the action item together without giving the committee time to review.
Right, that would have to be
Okay.
the way we'd have to do it, yes.
Thank you.
Okay, so without any other items anyone wants to bring up?
I just had one quick item, and I think it bears just a quick clarification. Previously, we had voted to shorten the deferred comp meeting timing, and I'm wondering if you wanted to go back to the regular pre-scheduled timing, which was till 11:30. It was 9 to 11:30 previously. If you would you like me to add that to the action item for January?
To be fair, most days we're out of here by 10:10. This one was quite a bit more stuff to go over and possible replacement of funds, so I think that was what was going on here. I don't feel the need to, I think 11 a.m. being our targeted end date, we're still going to beat that by 45 minutes most days, so.
Perfect. Okay.
But thank you.
Any other questions, comments, concerns from the committee? No? Then this meeting is adjourned at 11:27 a.m. Thank you.